Hello everyone. The topic for today is going to be investing. The objective of investing should include sorting through available securities to construct a diverse portfolio. You want to set up your portfolio so that it will still perform during tough economic times. The incentive for investing is the future compensation that an investor will receive. In order to achieve high relief in the future, you must reserve current fundings today. This requires foregoing immediate consumption of your income and taking on the risk of inflation and decreasing value of a dollar. Now, there are two types of investments. You can invest in real assets, which are physical things that are tangible and they're valued based off of their physical properties. This would be real estate, commodity, gold, things of that nature. And you have financial assets. Now, these are legal claims on documents and they are intangible. Of financial assets, there are 5 categories. You have commodity futures, preferred stock, creditor claims, indirect equity, and direct equity claims. Those are the 5 types of financial assets that an individual can invest in. Now, when setting your financial goals, you want to make sure that you really understand your susceptibility to risk. You have a risk of losing purchasing power in the future because of inflation. And things such as your age and your economic condition will kind of help determine what type of risk you're able to take. For example, if you're a nurse working in the oncology department and you make about $200,000 a year, you have a little more flexibility and a little more room for, let's say, a $3,500 loss versus, let's say, a cab driver who earns maybe $55,000 a year and their income is fairly fixed. A $35,000 loss to, a $3,500 loss will be a little more impactful for that cab driver than for the nurse based off of the difference in the earnings that they have. And the same thing follows with age. Of course, when you're younger, you have a little more room to make risky decisions with your income based off of the assumption that you'll live long versus an elderly individual who has a little less room for risky investments. One of the things to take into account with your risk is that whether you are low risk or high risk. Low risk investors are those individuals that will seek short-term debt instruments such as government bonds or corporate bonds. They'll invest in money market funds such as mutual funds, and those type of funds allow small investors to put a lot of money together and get a higher return on their investment. Then you have those that are more aggressive within the market and they can take on a little more risk. They will reserve funding for the long term using debt instruments such as common stock or real asset. Another thing to take into consideration is if you're looking to generate current income or you're looking for capital appreciation. If you're looking for current income from your investments, you're going to want to look at those high yielding mature funds, your public utilities, your chemicals, your apparels, things of that nature. Now, if you're looking for capital appreciation, you're going to be looking for a price gain. You're going to be looking at energies, small businesses, technologies, electronic stocks. You want to put your money in here because increasing the value of the business is going to increase the price for future sellings. You're going to look at see how the capital has gained over the time that you've held those investments. Another thing to look at is your liquidity concerns. Liquidity would be how quick you can convert your assets into cash. Now, some things to take into consideration would be the time. Or do you have long-term investments such as real estate, or do you have short-term investments such as stock? You want to understand how long it's going to take you to turn that investment into cash and to receive a return on your investment. You're going to also want to look at commission and transaction costs. Sometimes taking money out of the certain type of security that you have is going to cost you. And you're going to want to take into consideration those type of fees that are involved with taking your money in and out of the market. those are some of the things that I think you should think about going into investing. And if you have any other questions, feel free to leave me a comment. And I will have some more videos on this topic, as well as some definitions can be found underneath my name in the video, and you'll be able to see a little bit more, and we'll take it to another level with the understanding of investing and setting financial goals.